Okay, let's turn our attention to some definitions of business combinations. Now, I think really what we need to note here is the definitions that we see here for business combinations in financial reporting analysis differ from the definitions that we see in corporate finance later on. So just be a little bit careful. Notice with a merger, you've got two companies, company A, company B, and at the end you end up with just company A. In other words, company A is purchasing the net assets, so the assets and liabilities from company B. You end up with company B that essentially has a load of cash and equity, and it normally pays out a liquidating dividend and then ceases to exist. With an acquisition, and of course we're doing acquisition accounting here in financial reporting analysis, notice essentially we've got two companies coming together, company A and company B. Now here, of course, company A is acquiring company B, so typically it's buying the share capital. So you end up with a structure where company A is the parent company and company B is the subsidiary. Now let's look at a consolidation. Now I typically think of these as mergers. You've got two companies coming together to form a new company. So company A and company B come together to form company C. Now notice company A and B cease to exist and a new company C is created. Now typically therefore the shares in company C will be held by the original shareholders of company A and company B. Okay, let's look at a variable interest entity, VIEs, US GAAP phrase, VIEs. Often we're going to refer to these under IFRS as special purpose vehicles or special purpose entities. Here, the key is that control is based not on equity ownership. So the majority shareholder may not own the majority of the, may not have the risk and the reward of this entity. Now consolidation, we're going to see, certainly post Enron, is based on risk and reward. If you have the risk and reward, it's going to be your subsidiary. You're going to be forced to consolidate, whether you have one share or whether you have all the shares. Okay, so control is not based on share ownership with a VIE. We'll talk more about those later. Right, earlier on we mentioned partial and full goodwill. In our previous examples, actually when we do equity accounting, we're calculating partial goodwill. And in our acquisition example earlier, we looked at partial goodwill. Now, what we're seeing on this slide is that US GAAP requires a different measure of goodwill. It requires full goodwill. IFRS actually gives us a choice, partial goodwill or full goodwill. Okay, so partial goodwill we've already calculated earlier on. What we did is we looked at the price we paid to acquire a subsidiary or an associate, and we compared it to the share of net assets that we were acquiring. Now, of course, remember, with those net assets, we didn't take book values, balance sheet values, we had to make fair market value adjustments. So notice goodwill, therefore, purchase price minus the percentage owned times the fair value of identifiable net assets. In other words, our share of the net assets. So notice goodwill there in partial goodwill is reflecting essentially the shares that you own rather than the net assets you control. Now, with partial goodwill, our non-controlling, i.e. our minority interest that's going to be sitting in stockholders' equity is going to be the minority's share of the equity. In other words, the percentage that we don't own, the percentage not owned by the parent company, times the fair market value of identifiable net assets, so assets minus liabilities. Now let's turn our attention to full goodwill. Now notice full goodwill is the total fair value of the subsidiary minus 100% of the fair value of identifiable net assets. So we're taking the total fair value of the subsidiary, whether we own 100% or not, and comparing it to 100% of the net assets after we've made fair market value adjustments. Now I think what we should underline here is partial and full goodwill will be identical for 100% owned subsidiaries. So this distinction between partial and full goodwill is only going to kick in where we've got minority interests in the equation. So full goodwill, total fair value of the subsidiary minus the fair market value of net assets. Notice the non-controlling interest has to be calculated differently under full goodwill. Again, has to be different to keep the balance sheet balancing. So notice what we're simply doing here is we're bringing in the minority share of the fair market value of the subsidiary rather than the fair market value of the net assets of the subsidiary. Okay, let's have a look at an example to try and illustrate these points that we're making here. So we've got a company purchasing 70% of a subsidiary. Now, of course, here we go. It's 70%, meaning partial and full goodwill are going to be different. And we can see here's the consideration that we pay, $1.4 million. Now notice, in order to establish the total fair value of the subsidiary, let's take the $1.4 million and divide by the equity we're acquiring, i.e. 70%. So if we paid $1.4 million for 70% of the company, 100% of the company must be worth $2 million. We've also taken the subsidiary's balance sheet, we've run through and adjusted from book value to fair market value on a line-by-line basis, i.e. adjusting each asset and liability to fair market value. Now when we do that, if we look at the fair value of identifiable assets less identifiable liabilities, we get $1.7 million here. Now notice what full goodwill is therefore. We take the fair value of 100% of the subsidiary, i.e. the $2 million figure, and we deduct 100% of the fair market value of identifiable net assets. So 2 million minus 1.7 million, and we end up with 300,000. Now notice partial goodwill, a shortcut in terms of calculating partial goodwill. Take the full goodwill figure, the $300,000, and simply multiply by the 70% ownership. Again, if full goodwill really represents 100% of the equity, then partial goodwill only represents our share of the equity, 70%. So 70% of 300,000, and that leaves us with 210,000. Again, really to compare the two methods beside each other. So notice what we've got is we've got our full goodwill, required under US GAAP, and partial goodwill allowed under IFRS. So remember IFRS, we've got the choice, full or partial. So notice the goodwill calculation, the fair market value of 100% of the equity, so 2 million, minus the fair market value of 100% of the identifiable net assets after making fair market value adjustments, giving us 300,000. Now let's compare that to partial goodwill. This doesn't look at 100%, it looks at the price that we paid to acquire our 70% stake. So we paid $1.4 million to acquire our 70% stake, and therefore we've acquired the ownership, if you like, of 70% of the net assets. So we're going to take 100% of the net assets after fair market value adjustments, the 1.7 million, and multiply it by our 70% share to get our share of the identifiable net assets. So if we take 1.7 million times 70%, then we're left with 1,190,000. So 1.4 million minus 1,190,000, that gives us our partial goodwill figure of 210,000. Again, notice how easy it is to move between the two figures. If you've got full goodwill, all you need to do is take that figure, multiply by 70% our ownership stake, and that gives us partial goodwill. Likewise, if you've been given partial goodwill and you need to get to full goodwill, all you need to do is divide by 0.7 and you're going to get full goodwill. Let's turn our attention to the minority interest, otherwise referred to as non-controlling interest. Remember, these are going to be sitting in the equity area of the group accounts. So for full goodwill, we take the minority share. Well, if we own 70%, minority shareholders own 30%, and we multiply it by the fair market value of the subsidiary. Okay, the 2 million figure to get 600,000. Notice when we're doing partial goodwill, again we take the minority share, but this time we're not taking the fair market value of the subsidiary, we're taking the fair market value of the identifiable net assets, i.e. that 1.7 million figure. So 30% of 1.7 million, and you get 510,000. So what you actually therefore notice that under full goodwill, our goodwill figure is $90,000 higher than partial goodwill, and when we look at our minority interest, that too is $90,000 higher than the partial method. In other words, essentially our intangible assets are higher by 90,000 and our stockholders' equity is higher by 90,000 if we use the full goodwill method. Again, there's the point we're making. Look, this only has an implication for subsidiaries where there are minority interests. If we're looking at a subsidiary where we own 100% of the equity capital, then by definition, full goodwill and partial goodwill, of course, are identical. Now, let's talk about impairment of goodwill. Goodwill is deemed to be an infinite, or potentially infinite, asset. It doesn't have a finite life. And in that situation, if we have an asset that has an infinite life, we're not forced to amortize. So we're not going to amortize goodwill, but it must be tested annually for impairments. Now again, yes, goodwill cannot be separated from the overall business. You can't sell goodwill as a separate asset. It's essentially everything that is tied up that is not on the balance sheet. So we've got the identifiable assets and liabilities, then we've got everything that's not in the balance sheet, such as relationships with suppliers, relationships with customers, our employee relationships, etc., that really is represented by goodwill. And we can't sell those items separately. So we can't separate it and sell it from the overall business. Now notice, goodwill is going to be impaired when the carrying value of a business unit, carrying value phrase again, meaning balance sheet value, so that's going to be the net assets that we've included in our group balance sheet plus the goodwill figure. So when the carrying value of the business unit, goodwill plus net assets, is greater than fair value. So we're worried that the fair value of the subsidiary has declined below the carrying value. Then essentially we have an impairment. Now, of course, we're going to reduce the goodwill for the impairment in the balance sheet, and the other side is going to be an expense in the income statement. So it is going to hit the income statement, and of course, typically it's going to be an unusual or infrequent item. Now notice, goodwill impairments cannot be reversed. No surprise with US GAAP, it pretty much never lets us reverse impairments. The one caveat to that is on assets held for sale rather than assets held for use. IFRS, though, remember, typically does allow us to reverse impairments. We've now seen two exceptions to this rule. Number one, on equity accounted associates. Now we're also seeing it on goodwill. Why? Well, I think really the impairment has so much subjectivity in it, it's just too dangerous to allow us to impair and then subsequently reverse. The scope for earnings management is too big even for IFRS. Okay, so let's have a look at IFRS. With the impairment of goodwill, it says it's allocated across the cash-generating units that essentially will benefit from the acquisition. What are the cash-generating units? Divisions. If you've got any other divisions within the company that benefit essentially from having this subsidiary that's been impaired, then essentially when you impair the goodwill, that is allocated to each of the divisions within the company. Now again, US GAAP says very similar, allocated across reporting units. And now again, there could be a slight difference between a cash-generating unit and a reporting unit. You could have a reporting unit that doesn't actually generate cash itself. Really, maybe it's a centralized service within the firm. Okay, now let's have a look at the actual process of impairment, IFRS versus US GAAP. And all the time, I want you to be thinking here, look at how subjective these numbers are. So IFRS uses a one-step process. It says if the recoverable amount of the cash-generating unit is less than the carrying value, then the difference is an impairment. Now remember what the carrying value of our subsidiary is. It's the goodwill figure plus essentially the net assets that we've included in our balance sheet. Now what we're saying essentially is if this subsidiary's fair value has declined below goodwill plus net assets, then we have an impairment. Now here's the issue, of course. How do we know what the fair value of our subsidiary is? Now if it's a listed company in its own right, we of course could look up its market capitalization as an estimate of fair value. But if we're looking at an unlisted company, which quite frankly is most likely to be the case, how do we establish the fair value of the subsidiary? We're going to need some kind of valuation methodology, I don't know, free cash flow modeling maybe, and of course once we get into valuation modeling, there's huge amounts of subjectivity being built in. Small tweaks to our assumptions are going to give big swings in fair value. So a very subjective process indeed. Now notice US GAAP, it's a two-step process for US GAAP. The first step, you can see, is pretty much the same as IFRS. look at the fair value of the subsidiary and compare it to the carrying value, i.e. the net assets plus the goodwill figure. And if the fair value is below the carrying value, the balance sheet figures, then we've got an impairment. So we then move down to step 2, and that's measuring that impairment. Okay, now notice the amount of the impairment is the unit's reported goodwill, so the original goodwill that we generated on acquisition, compared to the current fair value of goodwill. So what we're going to try and do is we're going to do a new goodwill calculation at the current point in time. We're going to then compare that to the original goodwill, and if the new goodwill is lower than the original goodwill, the difference is the impairment. Okay, now as well, look, if the loss is greater than unit goodwill, the remainder is allocated proportionally to other non-cash assets of the unit. What we're simply saying here is, what if the impairment of the goodwill is greater than goodwill reported in the financial statements? Well, of course, first of all, we would bring down the goodwill to 0. Then rather than taking the excess, if you like, into the income statement, what we're going to do is net it off against any other non-cash items in the reporting unit. Under US GAAP, notice if the loss is greater than the current fair value of unit goodwill, so again, if our impairment is bigger than the reported goodwill in the balance sheet, we reduce goodwill down to 0, and that's it. So a difference here, IFRS reduces goodwill down to 0, and if there's any excess because the impairment is larger than goodwill, it nets it against non-cash assets of the subsidiary. Whereas US GAAP is reducing goodwill down to 0, and if there's anything left over, essentially it's throwing it away. Okay, again, under both standards, impairment loss is recognized in the income statement as a separate line. We reduce the goodwill in the balance sheet. Other side, it appears as an expense in the income statement, unusual or infrequent items. Okay, let's have a little look at an example now of goodwill. So we've got Hoops here that acquired a subsidiary called Parejo, and they bought them for $1 billion. The fair value of net assets at this time was 800 million. Okay, so fair market value of net assets, 800 million. I think we can assume that it's 100% subsidiary because we haven't been told otherwise. So goodwill was allocated to a single reporting unit that we're told here. At the end of the current year, Parejo had a carrying value of 1.2 billion. So the total balance sheet value of our subsidiary is now 1.2 billion. Now, of course, when we purchased it, you can see that the goodwill figure would have been 200,000. So that 1.2 billion must be 200,000 of goodwill, and the rest, the remaining 1 billion, must be its net assets, essentially. Now, we're told the fair value of Parejo is now 1.1 billion. Now, of course, what we can see is immediately we have an impairment. The fair value of the subsidiary, and quite how we establish that is another matter, but the fair value of the subsidiary is 1.1 billion, whereas the carrying value of the subsidiary plus its goodwill is 1.2 billion. We're also told that the fair market value of its net assets at the current date, so not at the acquisition, but at the current date, is 950 million. So what was the goodwill at the time of the acquisition? Well, that's relatively straightforward. 1 billion less 800 million, 200,000. Has there been an impairment? Yes, to both IFRS and US GAAP. Essentially, the fair value is 1.1, the carrying value is 1.2. Now, IFRS, of course, would measure that impairment as 100,000. US GAAP only uses that rule to identify that there's been an impairment. What we've then got to do is recompute goodwill. Okay, so let's have a look. First of all, on acquisition here, so when we acquire Parejo, there's the proceeds, 1 billion. There's the fair market value of the net assets we've acquired, 800 million, and therefore there's the goodwill figure, 200 million. Okay, now, current period, notice, then to identify, we're looking at the total carrying value, 1.2 billion, so that's 1 billion of net assets and 200 million of goodwill, compared to the fair value, remember, of our subsidiary. So there has been an impairment. And remember, IFRS would then look at the impairment and say, okay, that's essentially a 100 million impairment, and it would reduce goodwill from 200 million down to 100 million in the balance sheet, and essentially it would put a 100 million unusual or infrequent item through the income statement. But remember, under US GAAP, that's just used for identification. What we now need to do is actually measure the loss. Now, under US GAAP, we're going to do that, if you like, by recalculating goodwill. Now, the original goodwill, 200 million, we then do a kind of, let's have a look at goodwill right now. There's the fair market value of the subsidiary at the current point. There's what we think the fair market value of its net assets are. So if we were to calculate right now, we would have a goodwill figure of 150 million. So our original goodwill was 200 million, we've now got 150 million, and therefore we've got an impairment loss of 50 million. Down comes goodwill in our group balance sheet from 200 down to 150, and the 50 million loss hits the income statement as our unusual or infrequent item. Bargain purchase, this is really saying negative goodwill. What happens if the price you pay is less than the share of fair market value net assets you acquire? Can we have negative goodwill? Can we have a negative asset in the balance sheet? Answer is, under both IFRS and US GAAP, no. If you end up with a negative goodwill figure, well, first the accounting standards say, this is odd. Why is somebody selling you a subsidiary at a value lower than its net assets? After making fair market value adjustments, of course. So straight away we should question the fair market value adjustments that we've made at the date of acquisition. If when we've done that we really do believe that we've got a bargain, i.e. we've acquired a company paying less than the fair market value of net assets we've acquired, i.e. we've got negative goodwill, we take that negative goodwill as a gain to the income statement. Again, typically it's an unusual item here, so we're going to report it as unusual or infrequent. Recognition and measurement of identifiable assets and liabilities. Well, at the date of the acquisition, we take our subsidiary's balance sheet and we look at all of its assets and liabilities and adjust them, of course, to fair value. Now, at that point, notice the acquirer must recognize assets and liabilities that the acquiree, i.e. the subsidiary, had not recognized. So, for example, you might have a subsidiary that's been engaged in research and development expenditure. Now, we know R&D under US GAAP is going to be expensed through the income statement. But if we acquire that subsidiary, we're meant to work out what the fair market value of that R&D is worth to us right now, and we're meant to put it in to the net assets at the date of acquisition. Now, of course, that's going to have an impact on net assets and therefore the goodwill that we calculate. I think it's worth knowing as well that there's always an incentive for a company to minimize the fair market value of net assets and therefore maximize goodwill. Why is this the case? Well, typically what we find is if we make fair market value adjustments to our net assets that increase our net assets, they will have a knock-on effect on future income statements. Let's take an example. So, for example, if we increase the value of PP&E from book value to fair market value, the impact on future income statements is greater depreciation. We're now depreciating a larger value in the group balance sheet. So if you increase the fair market value of net assets, you're going to essentially have an impact on future earnings. Whereas if we minimize the fair market value of net assets and therefore maximize the value of goodwill, that isn't necessarily going to impact on future income statements. Remember, goodwill is no longer amortized. The only time it is going to have an effect on future earnings, of course, is if there's an impairment of goodwill. And we've already said that's massively subjective. Contingent liabilities. What is a contingent liability? It is a liability where the outcome is uncertain. I think the classic example of a contingent liability is a lawsuit. So you're being sued. Now, of course, you might lose that lawsuit, in which case there's going to be a future cash outflow, but you might win that lawsuit, in which case there won't be. So we've got a liability that is dependent on a future event, in this case, the legal proceedings. So any liability dependent on future events is going to be referred to as a contingent liability. Now notice IFRS says include it in the balance sheet net assets of the subsidiary at the date of acquisition if we can measure it reliably. US GAAP says, again, include it in the balance sheet net assets of the subsidiary at acquisition if it is probable, in other words, we're probably going to lose the lawsuit and we can reliably estimate it. And really this reliable estimation is meaning we can put a dollar value, a monetary value on this contingent liability. Indemnification assets. So we bought a subsidiary, maybe there was a contingent liability, and we asked the seller of the subsidiary to indemnify us. In other words, if this contingent liability actually is realized, they have to indemnify us, pay us some extra cash, essentially. Now again, notice that in the net assets of the subsidiary at the date of acquisition, we must recognize an asset. Okay, we must recognize an indemnification asset if we have a contract, i.e. the seller contractually indemnifies this contingent liability. So what we're saying is not only we'd have a contingent liability in this situation, but we would also have a contingent asset for the indemnification. Financial assets and liabilities. We've acquired a subsidiary and maybe it has financial assets and liabilities, held to maturity, available for sale, trading securities. Notice at the date of acquisition, essentially we can change the classification of financial assets and liabilities to bring them in line with the parent's accounting policies. In process R&D, so this is research and development that is ongoing within the subsidiary. Notice that both IFRS and US GAAP say capitalize it, include it in the balance sheet net assets of the subsidiary at the moment of acquisition, and then of course amortize it in the future, so it's going to have a knock-on impact in future income statements. So we've now got a situation where we might see research and development in the balance sheet under US GAAP. Now remember, US GAAP says expense research and development typically. But now if we've acquired R&D by acquiring a subsidiary, it's going to be an intangible asset at the date of acquisition in the subsidiary's balance sheet. We're then going to amortize it going forward. Likewise with IFRS, of course, they say expense research, you may capitalize development, but again, here we are capitalizing it all and including it at the date of acquisition in our subsidiary's balance sheet. Restructuring costs. Okay, so this is the idea that you acquire a subsidiary, then you're going to restructure it. Maybe there'll be redundancies, restructuring of divisions, etc. Now notice it says this is not part of the acquisition cost. So we cannot include it in, we can't include a liability, if you like, for restructuring at the date of acquisition in the subsidiary's accounts. Instead, we're meant to expense it through the group accounts when we incur it in the future. So no asset liability created for restructuring costs relating to restructuring your subsidiary once it's been acquired. Contingent consideration, little bit on contingent consideration. This is the kind of earn-out idea. So the idea here is that the buyer of the subsidiary is maybe paying some price up front, but then the amount of the consideration may increase, often dependent on the future results of the subsidiary. Now, so the idea is we don't know the total price we're paying for the subsidiary at the date of the acquisition, because that price is dependent on future events. Now notice both IFRS and US GAAP say recognize estimated fair value at acquisition as an asset. In other words, what we've got to do is estimate the total price of acquiring the subsidiary, including any contingent consideration. Now what we'd probably do is estimate the future payments we might need to make, discount them back and add them to the purchase price. Now that's going to make our purchase price higher, of course. Given that net assets wouldn't change, if we make our purchase price higher, then we're going to have higher goodwill. So you can see there would be an asset implication in terms of higher goodwill. Now it also mentions as a liability or equity. Goodwill can't just increase on its own. You can't just increase assets. The balance sheet wouldn't balance. So we're also saying the present value of this contingent consideration needs to go elsewhere as well. Liability, maybe if we're going to issue more cash or we're going to pay this contingent consideration via extra cash in the future. Equity may be if it's a share-for-share transaction, i.e. we might need to issue more shares to the seller in the future. So whether it's liability or equity really depends on how the acquisition is financed. If it's financed by cash and debt, you're going to create a liability for the contingent consideration. If it's financed by a share-for-share transaction, you're going to create equity. Yeah, changes in the fair value of liabilities will go to the income statement. So of course, the value of this contingent consideration may fluctuate over time as we realize, we're going to have to pay out more to the seller, or we're going to have to pay out less to the seller, dependent on essentially whether we're hitting contractual points. Okay, so we might have to adjust the contingent consideration, and notice we're saying if the fair value of the liability changes, then take it to the income statement. If essentially it's equity because it's a share-for-share transaction, then we don't take it to the income statement, we include it within our equity. Okay, notice US GAAP changes in the fair value of assets as well will go to the income statement. Right, let's have a little look at a comparison of our methods together. Equity method versus acquisition method. Again, the focus for the exam is going to be how do these two methods affect the financial statements, and therefore how do they affect the ratios that you calculated. Now, under the equity method, of course, your sales are going to be lower. Of course they are, because under the equity method, remember we're seeing a one-line consolidation. We're only seeing one line in the income statement, and remember that one line in the group income statement comes after the tax expense. That means when we look at sales, all we're seeing is the parent company's sales. Of course, when we look at acquisition accounting, we're seeing 100% of the parent company's sales plus 100% of the subsidiary sales, even if we don't own 100% of the subsidiary's equity, of course. Exactly the same for expenses. Under the equity method, we're only seeing the parent. Under the acquisition method, we're seeing 100% of parent and subsidiary combined. Now, of course, net income under the two methods will be exactly the same. How we arrived at it is wildly different. Under equity method, it's that one line. We're bringing in our share, if you like, of the associate's net income. Under the acquisition method, we're bringing in 100% of the revenues and expenses of the subsidiary on a line-by-line basis, and then of course what we're doing is we're deducting the net income that belongs to the minority. So we have a minority interest reducing net income in the group accounts, of course. Assets and liabilities under the equity method, typically lower. Again, remember, we only see one line for the associate in the group accounts. Now that one line, remember, contains three elements. It contains the goodwill, it contains our share of the book value of its net assets at the current point, and our share of any unamortized fair market value adjustments we made on acquisition. But we're seeing one line. Whereas under the acquisition method, when we look at assets, we're seeing 100% of the parent company's assets plus 100% of the subsidiary's assets added together. Now, why are we going to say that assets are lower under the equity method? Because of this one-line consolidation, remember, we're essentially netting the assets of the associate against its liabilities. What we're bringing into our one line is our share of its net assets. So you've got this netting process of assets against liabilities. Whereas under the acquisition method, we're not netting assets against liabilities. Now, when we look at liabilities under the equity method, chances are we are only going to see the parent company's liabilities. Well, not chances, we are. We're only going to see the parent company's liabilities, current liabilities, long-term liabilities of the parent. Whereas, of course, under the acquisition method, we're going to see both companies' liabilities combined. 100% of the parent, 100% of the subsidiary added together. Now, stockholders' equity, we're saying lower and higher. Now, I should say, look, this is only going to be the case for subsidiaries minority interest. If you have no minority interest, then they are going to be the same. Okay, that's one key point to make. Now, why is the equity under the acquisition method higher? It's because of the minority interest included in stockholders' equity. Now, if we were to remove this minority interest, then the stockholders' equity under the two methods would be identical. Okay, so it's only higher due to the minority interest. Now, this is quite controversial, isn't it? Because the minority interest doesn't actually belong to our shareholders. So maybe, treating it as a component of our stockholders' equity, it's never going to be paid out, so it's not really a liability, but it doesn't actually belong to our shareholders, so it's not really equity. Now, what that means is, in practice, when analysts are calculating equity-based ratios using group accounts, typically they remove the minority interest before calculating equity-based ratios. That's what analysts do in practice, but that's not what we're going to do in the CFA exam. Unless our examiner specifically says, remove the minority interest, you should calculate equity-based ratios using stockholders' equity, including the minority interest. As a result, under the acquisition method, we have higher stockholders' equity. Now let's have a look at a few of our ratios here. Leverage. Now I've said it depends, because what we're looking at here is debt over equity. Now, of course, it depends between the two methods. Let's imagine you're looking at the acquisition method. On the numerator, of course, you've got the debt of the parent plus the debt of the subsidiary. On the denominator, we've got the equity of the parent plus, of course, the minority interest. So it's difficult to say whether that's actually going to cause leverage to be higher under the acquisition method or lower. Of course, when we look at the equity method, really all we're seeing is the parent's debt over the parent's equity. So debt of parent over debt of equity. So again, what we're saying is don't really know on this one. Don't know whether acquisition method is going to give us higher or lower leverage, because we've got this impact on the numerator, but we've got the minority interest impacting the denominator. Current ratio, gross profit margins. Let's have a look at these. Now again, I've said depends between the two methods. Now, when we look at current ratio and gross margins, gross profit margins in the income statement, under the equity method, we're just seeing the parent company's ratio. I mean, current ratio, the current assets will just be the parent's current assets, the current liabilities will just be the parent's current liabilities under the equity method. Now, under the acquisition method, of course, we're seeing the current assets of the parent plus the current assets of the subsidiary over the current liabilities of the parent company over the plus the current liabilities of the subsidiary. So how's this going to affect the ratio? It rather depends. If the subsidiary has a better ratio than the parent, then acquisition method would bring in 100% of this improvement, so acquisition method would be better than equity method. Whereas if the subsidiary has a worse ratio than the parent, then of course acquisition brings in 100% of this worsening, and therefore the acquisition method would give you a lower ratio than equity method. So it's really a case-by-case basis. Now let's turn our attention to net profit margin, net income over sales. Now there's no doubt about this at all. Remember, net income is going to be the same under both methods, so it's all about the sales in this case. Under the equity method, we're just seeing the parent company's sales. Under acquisition, of course, we're seeing both companies' sales combined. So under acquisition accounting, the sales figure is going to be bigger, and therefore the net profit margin is going to be lower. Absolutely no qualms about that at all. So that's set in stone. What about return on equity? Now ROE, of course, net income over equity. Now we've said already that net income is the same under both methods. So it's all about the equity here. Now, what we should say, remember, is equity will be identical if you own 100% of the shares in the subsidiary. The only reason equity will differ between the two methods is when we have subsidiaries with minority interest. And remember, the reason we said was that the minority interest is considered a component of stockholders' equity. So if you have, under the acquisition method, subsidiaries that you don't wholly own, that's going to mean your equity will be slightly higher, and of course that means your ROE will be lower. So lower, but only if there are minorities around. Return on assets, net income over assets. Well, again, not much doubt about this ratio, you'll be pleased to know. Net income, of course, is the same, but we already said under the equity method, assets are going to be lower. Okay, so under the equity method we have lower assets, under acquisition we have higher assets. Why is that the case? Well, remember, under the equity method, we're essentially bringing in net assets of the associate. So we're netting assets against liabilities, whereas under the acquisition method, we bring in 100% of the assets separately, 100% of the liabilities separately. So assets are going to be higher under the acquisition method that drives this ratio down. Now let's turn our attention to special purpose entities, the last little bit of this reading. What is a special purpose entity? It's a separate legal structure, often a company, therefore, created to isolate certain assets and obligations of the sponsor. So we're holding assets and liabilities bankrupt remote from the original company. So if the original company, the sponsor, becomes bankrupt, well, the special purpose vehicle will continue to exist. So why do we create special purpose vehicles? Well, we're going to discuss again a lot of this with asset-backed securities, but certainly to serve specific purposes. Purchase assets, fund research and development, maybe keep R&D, risky research and development away from the main company, maybe to lease assets, or of course maybe to enhance the balance sheet. And of course we saw that before the credit crunch. Collateralized debt obligations set up in special purpose vehicles gave financial institutions a vehicle in which they could sell poor quality assets to, thus getting them out of their balance sheet. Now, of course, the main reason we have special purpose vehicles is to obtain lower cost financing. In other words, asset-backed securities. Here, of course, our sponsor is going to sell an asset, a cash-generating asset, into the special purpose vehicle. The special purpose vehicle then uses that asset to generate asset-backed securities, or to back asset-backed securities. Now, here is the key point. Prior to new accounting standards, and in particular, it's US GAAP that we're looking at here, special purpose entities did not need to be consolidated by the sponsor. Essentially, US GAAP in particular used the bright line criteria, i.e. share ownership. What that meant is, if you could set up a special purpose vehicle and avoid being the majority shareholder, you didn't need to consolidate it into your group accounts, even if you had all of the risk and the reward of the activities that the special purpose vehicle was up to. Now, of course, this created some large problems, and of course I'm thinking directly of Enron here, where Enron had a large number of special purpose vehicles that it had equity accounted rather than fully consolidated. Now, the problem with that, of course, is we were netting these special purpose vehicles' assets against their liabilities. We were bringing in our share of net assets. Now, a secondary point is that typically special purpose vehicles are very thinly capitalized. What does that mean? You might have very big assets, but you also have very big liabilities. So net assets, and hence stockholders' equity, are very small numbers. So if you've got a thinly capitalized special purpose vehicle with very low net assets, you end up bringing in your share of a very small figure, and these figures therefore appear tiny in the group accounts, even though the assets of the special purpose vehicle may be huge, and worse than that, so too may be the liabilities. So that was the issue. We were avoiding consolidation, essentially, prior to US GAAP changing the rules. So let's have a look at some uses of special purpose vehicles. Synthetic leases. Sell an asset to a special purpose vehicle and then immediately lease it back, of course. Now again, we might try and structure that as an operating lease when we lease the asset back. Securitized loans. Now, of course, this is the classic where we sell things like mortgages to a special purpose vehicle. Special purpose vehicle uses those mortgages to issue asset-backed securities, mortgage-backed securities. Then, of course, the cash flows generated on the assets, the actual underlying mortgages, are used to service the interest and principal on the mortgage-backed securities that are issued. Sale of accounts receivable is one that often comes up, selling our trade receivables. So what happens here is the sponsor company sells its accounts receivable to the special purpose vehicle. The special purpose vehicle then issues asset-backed securities. As the accounts receivable are collected, the cash flows are passed on to the asset-backed securities. Okay, now of course it's a way therefore of the sponsoring company accelerating the cash collections from its customers. R&D, slightly different motivation really with our research and development here. Most of the others are to do with financing, essentially, creating asset-backed securities. R&D is really to keep risky research and development and the funding of R&D off our balance sheet and off our income statement, essentially. Again, it's to keep it bankruptcy remote, so if the R&D makes losses and essentially the vehicle collapses, it doesn't have an impact necessarily on the company. Okay, so here's a classic special purpose vehicle. We've got a sponsoring company here. It sells an asset, so there's the asset, and it's going off to the special purpose vehicle. Now, of course, this special purpose vehicle needs to raise some cash to actually pay for the asset that it's acquired. So what it's going to do is issue asset-backed debt. Now, of course, the asset that's been sold to the special purpose entity is going to generate the cash flows that are going to be used to service the asset-backed debt. When investors pay for the asset-backed securities, cash enters the special purpose vehicle. It can then use this cash to pay for the asset that it's acquired. Now again, remember, prior to the new standards, the issue was US GAAP used bright line criteria, in other words, share ownership. Therefore, companies like Enron made sure that they were not the majority shareholder, and therefore they got away with equity accounting. And as we said, because a lot of these special purpose entities were very thinly capitalized, that meant we were bringing in our share of a very small net asset figure. So they look very irrelevant in the grand scheme of the company's balance sheet and income statement. Issue is, what if the sponsoring company still has all the risks? So notice that under the old rules, the majority equity ownership was not the sponsoring company. We'd have a third party, maybe financial advisors for the firm. They were going to hold the majority of the shares, but typically they didn't receive any risk or reward of the underlying special purpose vehicle. In other words, they were a majority shareholder in name only. Now, of course, post-Enron, this is rather changed. Now, IFRS was already saying, well, look, hang on a second. It's not the share ownership that matters here. It's the risk and the reward. So IFRS has always said, if you have the risk and reward, I don't care how much equity you have, you are the owner, you must consolidate. So here's the IFRS rules. Okay, so it says, look, you must consolidate. In other words, include 100% of the special purpose entity's assets in your company assets, 100% of its liability in your group liabilities. So when do we have to consolidate? If it's for our benefit. Okay, so if it's set up to benefit the sponsoring company, if the sponsor makes the decision-making power, has the decision-making power rather than the majority shareholder, if the sponsor, and I think this is the real key one, is able to absorb the rewards and risks. If you have the benefits, if you have the risks, it's your subsidiary regardless of the share ownership that you have. And that's the rule that IFRS has always towed here. Or if the sponsor has a residual interest, well, that's simply saying if we were to liquidate the special purpose entity, liquidate its assets, pay off its liabilities, if you were entitled to the residual that remains. Now, what essentially IFRS therefore has always been arguing, that we should consolidate based on economic substance rather than legal form. So if the economic substance is that it's your subsidiary because you have the risk and rewards, IFRS said you should consolidate. Now, US GAAP at this time, prior to Enron, was essentially disagreeing with IFRS. US GAAP took the view that legal form was more important than economic substance. Now, of course, Enron went boom, and US GAAP rather changed its opinion. So notice now, post-Enron, US GAAP introduced a new classification, and it started to talk about VIEs, variable interest entities. These were essentially special purpose vehicles that were controlled by a mechanism other than majority share ownership. So let's have a look at the definition and notice it is if any of the following conditions are met. First of all, insufficient at-risk investment, typically less than 10% of equity capital. What do they mean here? What they do is they look at the equity or stockholders' equity in the special purpose vehicle and compare it to the assets. And if equity is less than 10% of assets, they say, look, there's an insufficient at-risk investment. What does it mean? It means the equity is so small, the special purpose vehicle is so thinly capitalized that if the special purpose vehicle was to make losses, the equity there's not enough buffer for the equity to absorb them. In other words, the special purpose vehicle would require subsequent funding from the sponsor. Now then, US GAAP now goes to look at the majority shareholders, and it says if the majority shareholders don't have decision-making rights, if the majority shareholders don't have to absorb expected losses, and if the majority shareholders don't receive residual returns, then they're not really, in economic substance, the owner of this subsidiary. Let's go and find out who is, and of course chances are it will be the sponsoring company and the majority shareholders are just maybe a financial advisor. So what really US GAAP is now doing is it's coming in line with IFRS, and it's saying if the economic substance is you have the risks and the rewards of this entity, you must consolidate it regardless of the share ownership. Now even then, even post-Enron, there was still a classification called qualifying special purpose entities that essentially only related to special purpose entities that were acquiring financial assets and issuing asset-backed securities. And you could still get away with equity accounting those, all the way up to 2009, where qualifying special purpose entities were removed. Why were they removed? Well, of course, that's the credit crunch. And when the credit crunch kicked in, we found certain entities that had been using this classification to get away with equity accounting actually did have all of the risk and all of the reward. To be a qualifying special purpose entity, it had to be a financial asset that had been transferred from the sponsor to the vehicle, and it had the risk and the reward of that asset had to have transferred as well, so it couldn't be with the sponsoring company. When the credit crunch caused great losses, of course, it became rather apparent that a lot of companies were equity accounting even though they had the risk and the reward. So US GAAP moved to shut this down and eliminated qualifying special purpose entities. Okay, so let's have a look. The effects of consolidation. What's the new rules going to mean? Well, of course, the new rules mean that essentially it's going to be a subsidiary and we must consolidate it if we have the risk and reward. So any asset in the special purpose vehicle is going to get added back to the sponsoring company's assets. Any liabilities, i.e. the asset-backed securities, are going to be added to the sponsoring company's liabilities. In other words, we're no longer going to be able to keep these amounts off balance sheet. So we've got an example here of a securitization special purpose entity. Sponsoring company has sold accounts receivable to the special purpose vehicle that has issued asset-backed securities. Now notice, consolidation, the special purpose vehicle has, of course, these accounts receivable. Well, they get added back to the sponsor, so they come back into the sponsor's balance sheet. The asset-backed securities that are used to finance the special purpose vehicle, well, that of course is going to be added to the sponsor's liability. Significance therefore is the assets come back to the sponsor, the liabilities come back to the sponsor, essentially, so it's no longer off balance sheet. So that's going to increase leverage. Receivables in the balance sheet increase, therefore receivables turnover. Sales divided by average accounts receivable, that's going to decrease. Return on assets, of course, is going to decrease as well because we now have bigger assets. Key point, it's going to be harder now to use these for off-balance sheet financing. You know, if you've got the risk and the reward, it must be consolidated. So it's no longer off-balance sheet. That is the end result of the post-Enron, if you like, changes to accounting standards under US GAAP. Okay, so keys to our exam. The marketable securities, the held to maturity, the available for sale, the trading securities. Also know about the classification or reclassification between them. Know that US GAAP pretty much allows you to do whatever you want, whereas under IFRS you cannot classify into and out of fair value through profit or loss. Equity versus acquisition methods. The key focus is equity, the one-line consolidation, one line in the balance sheet, one line in the income statement, whilst the acquisition method effectively impacts on every line in the income statement and every line in the balance sheet. Focus on your IFRS versus US GAAP differences, always a good area for question writing. And of course, ultimately, we're not trying to turn you into bookkeepers here in financial reporting analysis. You're an analyst. You're comparing two companies, you're calculating the ratios. Therefore, you need to know how different accounting principles affect the financial data and therefore affect the ratios. So, effect on financial statements, and there it is. It's all about the ratios.